Understanding accounting vocabulary is an important first step in learning how accounting really works. So let's look at some key terms and their meanings. The journal, sometimes called the Book of Original Entry or more commonly the General Journal, is how transactions are entered into accounting records. It is a chronological list of a company's transactions. An account is a basic summary device used in accounting. All of the related transactions to a particular account are recorded in that account. For example, all of the transactions affecting cash would be recorded in the cash account. Accounts are grouped into 5 broad categories, which include assets, liabilities, equity, revenues, and expenses. We will learn how financial data moves from the journal into the account later. In an academic setting, the account is often expressed as a T account. 2 additional terms that are very important in accounting are debit and credit. Debit, which is sometimes abbreviated DR, means left side of an account. And credit, which is sometimes abbreviated CR, means right side of an account. And that's it. Debits and credits are how different accounts are increased or decreased, but they don't mean increase or decrease because it depends on which account they affect. Each transaction must affect 2 or more accounts to keep the accounting equation in balance. We learned this when we learned about the accounting equation. This is known as double entry accounting. So every transaction must include at least 2 accounts. One account that is debited and one account that is credited. There can be more than 2 accounts, but there can never be less. And debits must always equal credits, or the accounting equation would be out of balance. Account balances are either debit balances or credit balances. There are no negative balances in accounting. Balances are calculated by totaling the debit side of an account and totaling the credit side of the account. Then we subtract the smaller side from the larger. This is the balance on the larger side. An account can only have one balance. In this example, debits are $20,000 and credits are $9,000. So the balance in this account is an $11,000 debit balance. In this next example, debits are $15,000 and credits are $17,000. So the balance of this account is a $2,000 credit balance. The ledger, sometimes known as the general ledger, is a collection of all of the company's accounts. So all of the asset, liability, equity, revenue, and expense accounts are located in the ledger. Before we end this short video on accounting terms, I would like to revisit some terms and define the accounts a little better. Assets are economic resources, which means that it's something of value, that are owned or controlled by a business and will provide benefit into the future. The key when trying to determine if something is an asset is that assets will provide future benefits.